SpaceX just went public, and right now millions of people are watching the ticker climb and thinking the same thing. I need to get in before it's too late. Here's what nobody telling you that. The pop you're watching right now, the one everyone is celebrating, is not a victory. It's a countdown. And by the time this video is over, you'll have a specific calendar of dates, a specific price trigger, and the one piece of math that changes everything. Let's get into it. Welcome back to Money Made Simple, where we break down US money topics in plain English. No jargon, no fluff, just what actually matters. Hit subscribe if you're new. Let's go. Before anything else, let me be completely honest about what this video is and what it isn't. This is not a video about SpaceX being a bad company. By almost any measure, it's an extraordinary one. It launches more rockets than entire nations. Starlink now serves more than 10 million customers in over 150 countries. The defense contract pipeline runs deep. So if you came here looking for someone to tell you the rockets won't fly, that's not what this is. This is about something different, and in a way more important. The difference between a great company and a great investment at this price on this day. Those are not the same thing. And the gap between them is exactly where ordinary investors lose money on deals like this one. Let's start with what's actually underneath this stock, because the headlines won't tell you this part. In 2025, SpaceX brought in about $18.7 billion in revenue. That's a serious large business. But here's the first thing the coverage isn't leading with. In that same year, the company lost roughly $4.9 billion. It is currently not profitable. Now here's what surprises most people. Most of us think of SpaceX as a rocket company, but rockets are no longer the main story. The single biggest piece of the business is Starlink, the satellite internet service, which brought in about $11.4 billion, roughly 61% of all revenue. And more than that, Starlink is the only part of the company actually making money, generating around $4.4 billion in operating profit. The launch business, the rockets themselves, is growing, but slowly. The AI division is burning cash. So when you buy a share of SpaceX, you're really buying one profitable engine, Starlink, towing several heavy money-losing cars behind it. There's a reasonable case those other cars become valuable someday. But someday is doing a lot of work in that sentence. Now here's where it gets uncomfortable. Because I just showed you the business. Now I need to show you the price. And when you see these two numbers side by side, you're going to understand exactly why this video exists. SpaceX is going public at a valuation of $1.75 trillion, against last year's revenue of roughly $18.7 billion. That means you are paying approximately $94 of valuation for every single dollar of revenue this company brings in. 94 to 1. For a company that is currently losing money. Let me show you what that actually means. One of the most respected independent research firms on Wall Street ran its own detailed valuation of SpaceX. Their conclusion? The company is worth closer to $780 billion. That is more than 55% below the price it's going public at. So, the valuation already assumes the future has arrived. Everything coming after this is about who profits if it doesn't. Here's one more way to feel how stretched this is. Remember, Starlink is the only piece actually making money, about $4.4 billion in operating profit. If you valued that profit generously the way investors price a thriving, growing business, at say 40 times those earnings, that values Starlink at around $176 billion. The whole company is being sold to you for $1.75 trillion. The profitable core explains only about a tenth of the price. The other 90% is a bet on things that haven't happened yet. Now here's the part of this video that I haven't seen anywhere else. Instead of predicting what SpaceX will do, let me ask a different question. What would SpaceX actually have to achieve just to make buying at this price worth it? And to keep it fair, let's set the bar as low as we honestly can. Forget getting rich. Let's just ask, what does it take to match what you'd earn doing the boring thing, buying a plain index fund and forgetting about it? Call that around 10% a year. Start at the $1.75 trillion price. To grow at 10% a year for 10 years, SpaceX would need to be worth about $4.5 trillion a decade from now. Fine. Now what does the business have to look like to justify $4.5 trillion? Even being generous, the math demands the company be pulling in something like $566 billion in revenue. $566 billion. Up from about $18.7 billion today. That's roughly 30 times its current revenue. To get there in 10 years, SpaceX would have to grow its revenue around 41% every single year for 10 consecutive years without stumbling once. Almost no company at this scale in history has ever done that. And that Herculean result is what's required just to tie the index fund, just to break even against doing nothing. For you to actually come out ahead, reality has to beat even that. Now you understand the price, and you understand the math. But here's what most people watching today have completely missed. There is a specific clause buried in SpaceX's public filing, a specific dollar amount, a specific number of trading days that turns today's excitement into something else entirely. Let me show you exactly what it says. When a company goes public, only a small slice of its shares actually start trading on day one. In SpaceX's case, that slice is about 5% of the company. The other 95% is still held by the people who got there first. The founders, the employees, the venture firms. Those insiders aren't allowed to sell yet. They're contractually locked up. The reason is simple. If everyone who owned cheap shares could dump them on day one, the supply would crash the price instantly. So most big IPOs use what's called a lockup period, usually 180 days, to hold that supply back. Now here's where SpaceX did something unusual. Instead of one cliff at the end of 180 days, the way Rivian did, the way Uber did, the way almost every big IPO does, SpaceX built a staggered release schedule. 5 separate tranches that unlock at fixed intervals. 2 additional cliffs tied to earnings reports. And 1 performance trigger tied directly to the share price itself. That last part is the one I want to spend a moment on, because it's the part the headlines aren't covering. Here's what the prospectus actually says. If SPCX trades 30% above its IPO price for 5 out of any 10 consecutive trading days before the first quarterly earnings, report an additional 10% of insider shares unlock for sale early. Read that one more time slowly. 30% above the IPO price. 5 of 10 days before the first earnings report. 10% more insider supply gets released. The IPO price is $135. 30% above that is $175.50. The futures market, where traders have been pricing SPCX before today, has been sitting at around $155. That's already a 15% pop priced in, which means the trigger isn't sitting at a level the stock would have to soar to reach. The trigger is roughly 13% above where the market already expects the stock to be. One good week. That's all it takes. So here's what that clause actually does. It turns the day one pop, the thing everyone is celebrating right now, into the starting gun for early insider selling. The harder the stock runs in the first few weeks, the faster 10% of locked-up insider shares become free to sell. The pop isn't a victory lap, it's the trigger. Now let me show you the calendar. Because these dates are sitting in a public document right now. Anyone can read them. Almost nobody buying today has looked. Today, June 12th, is day 0. SpaceX is publicly traded. About 5% of the company is in the float. 95% is locked up. Now let's walk forward. Friday, August 20, first day 70. First tranche unlocks. 7% of insider shares become eligible for sale. Thursday, September 10th, day 90. Second tranche, another 7%. Friday, September 25th, day 105. Third tranche, 7%. Day 124th tranche, 7%. Day 135 fifth tranche, 7%. That's 35% of insider shares released across 5 dates between late August and late October. But those are just the time-based unlocks. 2 more cliffs land in between tied to earnings reports. The first cliff fires 2 days after SpaceX reports its first quarterly earnings. That's somewhere between mid-July and late September, depending on how the company schedules its first call. Whenever it lands 2 days later, an additional 20% of insider shares unlocks. That's bigger than any single staggered tranche. And the exact date isn't fixed in advance, which means the moment it actually arrives is something most retail buyers won't be tracking. The second cliff, tied to the Q3 earnings report, releases another 28%. Then December 9th, day 180, the standard lockup expiration. Every restriction that hasn't already lifted lifts now. Add it all up. 5 tranches at 7% each is 35. The Q2 cliff is 20. The Q3 cliff is 28. That's 83% of insider shares released before the calendar even hits day 180. By mid-December, 6 months from today, every restriction on the staggered schedule has lifted. That's the timeline you should be thinking about, not whatever the stock does in the first hour of trading. And one more date worth marking. June 13th, 2027, day 366. That's when Elon Musk's lockup ends. He cannot sell a single share for a full year. Every other insider, the early employees, the venture firms, the executives below the very top tier, is on the schedule we just walked through. By the time Musk's lockup even begins to lift, the rest of the insiders have had a full year of unlock windows to cash out into retail demand. The person at the top is protected. The people in the middle get multiple exit doors over the next 6 months. The person buying tomorrow on their phone, watching the ticker climb, is the demand all those exits are pointed at. Now I know what you're thinking. Has this happened before? Is this just theory? No, this exact pattern has played out in name after name in deals everyone said were once-in-a-lifetime opportunities. Let me show you the historical record. Because the data is brutal. Palantir went public in September 2020. Retail enthusiasm pushed the stock from around $10 at listing to levels near $40 by early 2021. Then the lockup expired. Insiders, including Peter Thiel, sold tens of millions of shares into the premium that retail had built. The stock fell 13% in a single session and spent months recovering. The expiration date was printed in the prospectus from day one. Almost nobody buying at $38 was tracking it. Rivian went public in November 2021. The opening day was one of the most exciting in recent memory. The stock jumped 22% above its IPO price, and a lot of buyers took that pop as proof they needed to get in fast. 6 months later, the lockup expired. Ford disclosed it would sell its entire stake. The stock dropped about 20% in a single day. Over the year that followed, it fell 67% from where it had peaked. Every one of those dates was visible to anyone who looked. Uber went public in May 2019 at $45 a share. By the time its lockup expired in November of that year, on the very day insiders were finally allowed to sell it, hit an all-time low. 40% below the IPO price on the expiration date itself. None of those were bad businesses. Most are still around. Some have recovered. The point isn't that SpaceX is going to collapse. The point is that the part of the deal that hurt retail investors in every one of those names, the unlock, is the part that's still ahead of us in this one. And SpaceX is going public at 94 times revenue. That's the highest premium of any major IPO in years. By that measure, the room for things to get rough is unusually wide. So where does that leave you if you're genuinely drawn to this company? Because I want to be fair. Recognizing everything I just laid out is not the same as saying you should never touch SpaceX. There's a smarter path than the 2 loud options. The first loud option: chase the hype. Buy today at the popped price right before the trigger window opens and the staggered tranches start unlocking. We've now seen step by step why that's the weakest seat in the house. The second loud option: write off the whole thing forever, which throws out a genuinely remarkable business because the deal structure wasn't fair on day one. The third path is quieter, and it costs you nothing but patience. You let the calendar do the work that hype is trying to rush you past. 6 months from now, every restriction on the staggered schedule will have lifted. The Q2 earnings report will have landed real numbers on the record you can hold the company to. The Q3 earnings will have landed too. The performance trigger window will have closed one way or the other. The forced index buying will have run its course. Every one of those events is a piece of real information replacing speculation. None of that requires you to predict anything. It just requires you to not be in a hurry. Here's the part worth remembering. The best companies of the last few decades stayed viable for years after their IPOs. You did not have to own them on day one to do extraordinarily well. The market rewards the patient far more reliably than it rewards the early. The thing being sold to you today as a once-in-a-lifetime act-now moment is almost always a stock that will still be there next quarter, at a price set by reality instead of by a countdown clock. Here are the specific dates worth marking on your calendar. Not for trading, but for sanity checking the story as it unfolds. Late August through late October, the staggered tranche window. 5 dates, 7% each. Watch what happens to the price at each one. Mid-July to late September, the first earnings report. Watch what gets disclosed. Watch whether the performance trigger has fired. Mid-October to late December, the second earnings report. Watch the Q3 numbers. December 9th, the standard 180-day expiration. The last 17% of insider supply becomes free to trade. By the time that final date passes, the price will reflect 6 months of reality instead of 1 day of countdown. That's the price worth deciding on, not the one on your screen right now. And June 13th, 2027, day 366. The day Musk's lockup ends. By then, you'll have 2 full years of earnings reports. You'll have real data on Starlink growth, real data on rocket revenue, real data on whether that 41% annual growth story is even beginning to materialize. That's when the story stops being a story and starts being a business. And that's when the math starts to make sense as a decision. Quick recap. SpaceX is an extraordinary company going public at an extraordinary price, 94 times revenue. The only profitable division, Starlink, explains about 1/10 of that price. The rest is a bet on things that haven't happened yet. To match a simple index fund, SpaceX needs to grow revenue 41% every year for 10 years straight. Almost nobody has ever done that. A hidden performance trigger at $175.50 could release extra insider shares the moment the stock runs hot. 5 staggered tranches unlock between August and October. 2 earnings cliffs release even more supply in between. 83% of insider shares are free to trade before the calendar even hits day 180. The pop is not a victory. The pop is the trigger. The calendar is quiet. The countdown is real. And patience is the only edge that's actually free. Now I want to hear from you in the comments. Are you planning to buy SpaceX on day 1, or are you going to wait and watch the calendar? Drop your honest answer below. I read every single one. And if this video showed you something the headlines missed, hit that subscribe button so you never miss another money breakdown like this. Check out the video on screen for more ways to build real wealth. See you in the next one.